BridgeBio Pharma, ticker BBIO, beat consensus on the top line, but missed on the bottom for Q2 2026.
Yeah, a pretty classic split decision this quarter.
Right. So total revenue came in at $243.68 million, which easily beats the consensus estimate of about $220.91 million.
And I mean, that represents a massive 120.4% increase year over year.
It's huge. But on the earnings per share side, they reported a loss of 78 cents per share, which missed the expected loss of 58 cents.
Right. So the burn is definitely higher than the street wanted.
Exactly. Now, management did maintain their target of reaching break-even profitability by late 2026 or early 2027.
Yeah, they're basically projecting those operating losses to flatten out as revenues just continue to scale up.
And honestly, the market seemed to digest all of this pretty well. Shares ticked up over 1% and after hours trading to $85.78.
Which really reflects market confidence in that massive top-line growth, despite the earnings miss.
Yeah, and that followed a really strong regular session, too. The stock actually touched intraday highs of $93.42.
It was a very volatile, very active session for sure.
So today, we're taking a deep dive into BridgeBio's latest earnings reports, their balance sheet, and, management commentary.
There is a lot to unpack here.
There really is. Our mission for you today is to figure out if their commercial rocket ship is enough to outrun a massive mountain of debt.
Because that debt is no joke.
No, it's not. We want to know what these numbers actually mean for you. If you're trying to figure out how to value a company that is, well, growing at triple digits, but still aggressively losing money.
Yeah, the dynamic you're looking at here is a classic biotech commercialization scenario, but it's amplified to an extreme degree.
Right, like the volume is turned all the way up.
Exactly. You have a top line that is expanding so rapidly that the street is they're willing to completely look past the near-term bottom line drag, at least for now.
Investors are focusing entirely on the trajectory.
Yeah. But to really understand if this dynamic is sustainable, we can't just recite the headline numbers. We have to look under the hood at exactly where that $243 million is coming from.
Because the revenue composition tells us everything we need to know about their market execution.
Spot on. It's all about where the cash is actually originating.
Okay, let's unpack this. Because when you look at the breakdown of those revenues, the first thing that jumps out is how incredibly concentrated it is.
Oh, absolutely. The undeniable star of the show here is Attruby, or acoramidis.
Right, which is their treatment for ATTR-CM.
Yes. And just for some context for anyone listening, ATTR-CM is a progressive disease where these abnormal proteins basically misfold and build up in the heart.
It's a very serious condition.
It is. And Attruby brought in $222.44 million in U.S. net product revenue alone.
Which is just, that is a staggering 211% surge.
It's incredible growth for a single quarter.
I like to think of Attruby as the heavy lift rocket of BridgeBio's commercial fleet right now. It is carrying almost the entire revenue weight of the company into orbit.
Yeah, literally trying to pull the rest of the pipeline along with it. Your heavy lift rocket analogy works perfectly to illustrate that concentration. But it's important to recognize that this launch is it's a global operation.
Right. They aren't just selling in the U.S.
Exactly. Rockets need an immense amount of precision engineering to keep flying straight. And right now, that precision is showing up in their international execution.
It's not just the U.S. market providing the thrust.
No, not at all. When you look at their royalty revenues, those spiked to $15.43 million.
Wow.
Which is up 850% year over year.
That's a massive jump. What's the mechanism driving that?
It's primarily ex-U.S. sales of the drug. In places like the European Union and Japan, it's marketed under the brand name Biontra.
Oh, okay, so Biontra is just Attruby abroad.
Basically, yeah. And pulling off a global commercial strategy simultaneously is incredibly complex for a mid-sized biotech.
Yet they are clearly gaining significant traction abroad.
They really are.
But, while product and royalty revenues are skyrocketing, there is a glaring drop in license and services revenue.
Yeah, you have to look closely at that one.
It fell to $5.8 million, which is way down from $37.4 million in the exact same quarter last year.
Right.
If you just glance at the spreadsheet, that looks like a massive red flag. Like, what went wrong there?
But looking at the timeline of their partnerships, this has to be an accounting quirk, right?
Exactly. Last year's numbers were artificially boosted by a one-time $30 million milestone payment from their partner, Election.
And that was tied to their regulatory approval of the drug in Japan, wasn't it?
Yes, exactly. So if you strip out that one-time anomaly from last year's comparisons, the underlying growth story of Attruby's direct sales is actually much steeper.
Much steeper than the headline numbers even imply.
Yeah.
That is the exact kind of nuance you have to look for in biotech earnings. When you remove that milestone distortion, the commercial momentum is just undeniable.
Right.
And it's vital to understand the mechanism of why this momentum is happening. It isn't just because they, hired a great sales team.
It's rooted in the clinical profile of the drug itself.
Exactly. Management cited real-world evidence showing Attruby is associated with fewer cardiovascular events and hospitalizations compared to its main rival.
Which is huge.
Yeah.
For a cardiologist treating a patient with heart failure, keeping that patient out of the hospital is the gold standard of care.
It's everything. Because of this data, you are seeing treatment-naive patients starting on the therapy.
And crucially, they are remaining on it.
Yes. High retention is the absolute lifeblood of any recurring revenue model in the pharmaceutical industry.
So the revenue engine is running incredibly hot.
Very hot.
But this is where the rocket analogy gets tricky, because rockets also burn an insane amount of fuel.
Oh, they burn so much fuel.
If this heavy lift rocket is performing flawlessly and patients are staying on the drug, why did they miss EPS estimates by 30%?
That's the big question.
They spent over $350 million in operating expenses this quarter alone. That is a massive cash burn.
It's huge.
If you're a retail investor looking at this, you have to be asking whether that level of spending is sustainable, or if they're just, buying revenue at a massive loss.
What's fascinating here is the sheer financial weight of transitioning from a development stage biotech company to a full-fledged commercial enterprise.
Right, it's a completely different business model.
It is. You don't just flip a switch when a drug gets approved by the FDA and watch the profits roll in.
Sadly, no.
Building out the commercial infrastructure requires immense upfront capital. You have to hire specialized sales forces, build out targeted marketing campaigns.
Secure global supply chains.
Exactly. And set up patient support programs that help patients navigate complex insurance reimbursements.
Which is not cheap.
Not at all. In Q2, their selling, general, and administrative expenses, the SG&A reached $186.2 million.
Wow. And at the exact same time, they can't abandon their future, so research and development expenses hit $149.4 million.
Right, because they have to continue pushing their other pipeline drugs through late-stage trials.
Wait, if they're burning through $186 million on SG&A and another $149 million on R&D,
Yeah.
and the cash flow statement shows operating activities used $268.4 million over just the first half of 2026.
The cash burn is astronomical.
It really is. But looking closely at the margins, their operating loss actually narrowed to $107.1 million this quarter.
Compared to $134.3 million in the same quarter last year.
Right. So that has to mean the gross margins on Attruby are so incredibly high that the new revenue is finally starting to eat into those massive fixed costs.
Exactly.
The revenue is finally starting to outrun the burn.
That is precisely the mechanism at work, and it's the first real sign of operating leverage for BridgeBio.
Okay, so the gross margins are good.
They're amazing. The gross margins on that $222 million in Attruby revenue are hovering around 94.6%.
94.6%. That's almost software margins.
It is. In the pharmaceutical space, once you finish the R&D and figure out how to manufacture a small molecule drug at scale,
The actual physical cost to produce a pill is practically nothing.
exactly. So almost 95 cents of every dollar of Attruby sold is gross profit.
That's wild.
Management's thesis is that the heavy lifting of building the commercial infrastructure is largely complete. The sales reps are hired, the systems are in place.
So moving forward, as revenue scales, those fixed costs will flatten out.
That's the plan, meaning every incremental dollar of that 94.6% margin revenue will drop almost directly to the bottom line.
Okay, that makes perfect sense in theory. But theory doesn't pay the vendors today.
True.
If they burn through nearly $270 million in operating cash in the first 6 months of the year, how is a company with such high R&D and commercialization costs avoiding diluting retail investor to zero?
Yeah, that's the fear, right?
Usually when a biotech burns cash like this to fund a launch, they just do a massive secondary offering on the open market and absolutely crush the existing shareholders.
Which brings us to the financial engineering that management is using to keep the lights on without destroying the share price.
Okay, what do they do?
Just after the quarter ended, on July 1st, 2026, they closed a massive strategic financing move,
How massive?
a $1 billion preferred equity financing deal.
Wow. $1 billion.
Yeah. This was led by Sixth Street, along with Healthcare Royalty, which is an affiliate of KKR.
Okay, so heavy hitters.
Definitely. And this is a very specific type of capital injection designed to bring in huge liquidity without the immediate brutal dilution you'd see from a common stock offering.
$1 billion is a serious war chest. But for anyone listening who isn't deep into corporate finance, we should probably explain how preferred equity actually functions here.
Yeah, that's a good idea.
Because it sits higher up in the capital structure than common stock.
Right.
If things go south, those institutional guys get their money back before retail investors see a single penny.
Absolutely. It often pays a dividend and has specific conversion rights.
So it comes with heavy strings attached. But the obvious benefit is that it avoids dumping $1 billion worth of common shares onto the retail market all at once.
You've nailed the trade-off. By structuring the deal this way with major institutional players, BridgeBio boosted its pro forma cash position to an impressive $1.72 billion.
Okay, $1.72 billion in cash.
And according to management's commentary, that runway is the bridge to their promised land.
They stated very clearly that this capital fully funds their 3 upcoming product launches, right?
Yes. And it gets them all the way to that targeted late 2026 or early 2027 profitability point.
So they're essentially telling the market, we have all the money we need to finish the job without coming back to you for more.
That is the exact message they are sending.
But here, this raises a massive red flag about the cost of that capital and the structural overhang on the company.
Yeah, you can't ignore the balance sheet.
We have to look at it as a whole because the liabilities are absolutely staggering. BridgeBio currently carries $3.72 billion in total liabilities.
That's a huge number.
Let me repeat that for anyone listening. $3.72 billion for a company doing roughly $243 million a quarter in revenue. That is an unbelievable amount of debt to carry, even if you have 94% gross margins.
It is a massive burden, and we really need to break down exactly what that $3.72 billion consists of.
Okay, where is it coming from?
The bulk of it comes from 2 primary buckets. First, they have $2.48 billion in convertible senior notes.
Okay, and this is debt that pays a fixed interest rate, but it gives the lender the option to convert that debt into common stock later at a predetermined price.
Exactly. It's a way to borrow money cheaper today, but it creates this looming threat of future dilution if the stock price rises above that conversion price.
Right, and what's the second bucket?
Second, they have $879.4 million in deferred royalty obligations.
Oh, man. A deferred royalty obligation is basically the biotech equivalent of a payday loan.
That's a great way to put it, honestly.
You get a lump sum of cash up front from an institutional investor today, but in exchange, you have to give up a fixed percentage of all your future drug sales.
Right. You're capping your future upside to fund your current survival.
And when you factor all of this in, BridgeBio actually has a massive total stockholder deficit of $2.50 billion.
Meaning the equity on the balance sheet is deeply negative.
Which brings up the most critical risk for anyone holding this stock. Concentration risk.
Definitely. Right now, Attruby is doing all the heavy lifting.
They are heavily dependent on this single asset to service that $3.72 billion mountain of debt and royalty obligations.
Yeah, if Attruby sales stall, the highly leveraged capital structure becomes an existential problem very quickly.
Here's where it gets really interesting, though. They're going head-to-head with Pfizer's Vyndamax.
Oh, yeah. The 800-pound gorilla.
Exactly, which is already a massive established blockbuster in this exact cardiac amyloidosis space.
Pfizer has limitless marketing muscle and deep, entrenched relationships with cardiologists.
Right, so if Pfizer decides to aggressively defend its turf, flex that marketing muscle, and Attruby's market share plateaus,
then BridgeBio's entire debt repayment strategy collapses.
Exactly.
And that is the primary bear case that keeps short sellers so interested in this stock.
But
if you look at the broader competitive landscape, it actually just shifted significantly in BridgeBio's favor.
wait, really? What happened?
A few weeks ago, a major rival drug being developed by AstraZeneca and Ionis suffered a phase 3 trial failure in this exact same space.
Oh, wow. In the biotech world, a phase 3 failure of a well-funded rival is a massive windfall for the incumbents.
It is huge. That failure was a shock to the market, and it effectively clears a huge portion of the future competitive landscape for Attruby.
So it removes a looming threat, allowing BridgeBio to focus solely on taking share from Pfizer.
Right, rather than fighting a 3-front war.
That Pfizer rivalry is exactly why they can't afford to be a one-trick pony, though. The AstraZeneca failure gives them breathing room. Right. But to truly outrun $3.72 billion in liabilities, They need a fleet of commercial assets, not just one rocket.
Which is exactly why they are aggressively pushing 3 other drugs through the pipeline right now.
They need to de-risk the company over the next 12 to 18 months by transitioning from a single product story to a diversified portfolio.
And the timeline for that transition is very compressed. They have 3 new drug application or NDA decisions rapidly approaching.
Okay, let's go through those.
The 2 most immediate are critical. First is BBP 418 for limb-girdle muscular dystrophy.
Got it. And what's the timeline on that one?
This has a PDUFA action date, which is the strict deadline for the FDA to issue a decision of November 27, 2026.
And it is currently under priority review, right?
It is, which means the FDA recognizes a significant unmet medical need.
Okay, what's next?
Then there is encaleret, targeting a rare calcium disorder called ADH1. That has a PDUFA date of May 8, 2027.
Okay, so that's 2 potential approvals in the next 12 months.
And on top of that, they have oral infigratinib for achondroplasia in the wings, which recently showed highly positive phase 3 data.
And that one is slated for regulatory filing later in 2026.
Exactly.
So if you're tracking this at home, we're looking at a company that could potentially have 3 or 4 commercial blockbuster drugs on the market by the end of 2027.
It's a very real possibility.
And if they pull that off, that $3.72 billion in liabilities suddenly starts to look a lot more manageable against a multi-billion-dollar diversified revenue stream.
Absolutely. But getting there requires incredible organizational focus.
Right. And this brings us to how BridgeBio actually operates on a fundamental level, because they don't run like a traditional centralized pharmaceutical giant.
No, they don't. They use what's called a hub-and-spoke model.
And that hub-and-spoke model is the crucial mechanism to understanding how they've built this pipeline so quickly.
Think of the central BridgeBio corporate entity, the hub like a venture capital firm.
It provides the capital, the legal support, and the shared administrative services.
Right. And then the spokes are these independent, decentralized subsidiary companies that focus solely on developing one specific drug or targeting one specific disease.
So it prevents the bureaucracy of a massive corporation from slowing down nimble R&D.
Exactly. The scientists and the spokes just focus on the science, while the hub handles all the complex financing.
It's an incredibly efficient way to run R&D, because if one spoke fails in clinical trials, you just shut it down without infecting the rest of the company.
Yeah, you just prune the dead branch.
But the flip side of that venture capital model is that your successful spokes, like the one that developed Attruby, have to generate enough cash to pay for all the failures and the massive overhead of the central hub.
It is the ultimate biotech balancing act.
It really is. You have a company executing a stellar commercial launch, securing massive non-dilutive financing, and advancing a pipeline that could yield multiple new approvals within the year. But it's all built on a foundation of significant debt and complex royalty agreements that leave retail investors staring down a $2.5 billion stockholder deficit.
The fundamental dynamic for BridgeBio is that it is a race. It is a race between their commercial execution and their own highly leveraged balance sheet.
The early data from the Attruby launch suggests they are running at an absolute sprint.
They are.
Okay.
But that pack they are carrying isn't getting any lighter in the near term.
No, it's not.
Every quarter is going to be a test of whether that top-line growth can translate into enough bottom-line cash to service the debt before the runway runs out.
Which brings us to the final provocative thought I want to leave you with today.
Let's hear it.
As BridgeBio attempts to transition from this nimble R&D-focused entity into a multi-product commercial giant, you have to ask yourself,
Okay.
does that decentralized hub-and-spoke model become too unwieldy and chaotic to manage under the crushing pressure of a $2.5 billion stockholder deficit?
That's a great question.
Or does that exact same diverse, de-risked portfolio of soon-to-be commercial assets make them an irresistible acquisition target for a mega-cap pharma company looking to just buy instant dominant market share in the rare disease space?
An acquisition would certainly solve the debt problem overnight.
It definitely would. It's something to chew on before their next earnings call. Be sure to follow the show for daily, no-nonsense earnings coverage.